out with their numbers?
We do have a very strong quarter and also for the full financial year 25. The business growth has been very significant in terms of strong growth on the advances side. On the domestic advances grown by 13.7%, and the global is almost at 12.8%, almost at 13%. So one of the key deliverables for us is to be a consistent. And if you look at our net profit, 2 out of 4 quarters we have posted more than 5,000 crore of net profit. And the full year has been 19,581 crore, which is almost 10% up from the last year.
Right.
So the aspect that is critical in this to understand that although the NII growth has been slightly subdued because of the cost structure on the deposit side, but we could optimize on the net interest income. The growth is almost 15% over there. And in terms of provisioning, because of better asset quality, the loan provisioning requirement is less as compared to last year, but the tax provision is almost the same. So given a scenario, you have a lower provisioning requirement because of the asset quality, your net profit growth has been very strong in that way. So I think it's a very strong both in terms of both top line and also at the same time bottom line, because we are able to keep the key deliverables in terms of optimizing on the net interest income, keeping the cost tight on the deposit side, that really help for posting a very strong net profit number for the full year.
Right. You had guided about over 3% of net interest margin, and you have delivered on that front.
Yeah.
But talking about FY26, not only your bank, there is expected pressure on margins. How do you plan to navigate that?
See, that's a very important, because this quarter is a very inflection point in the sense that two things have changed vis-a-vis Q1 over Q4 of last year. One is that the rate stance has clearly changed, and the liquidity has changed between deficit to surplus. So given that scenario, we have done a bit of cost moderation on the deposit. Wholesale deposit cost, the repricing happening at a lower rate, almost 40-50 bps over there. The retail term deposit, we have reduced the cost, but again, this is only for the new deposit to get repriced. So scenario, there would be a bit of lag effect in terms of this cost moderation and the impact on the floating rate advances side. So although there will be a bit of pressure on the Q1, because that's a very important quarter because of this change that happened, but for a full year basis, I expect the Q2, Q3 and Q4 would be better on the margin side, because by that time things would normalize on the cost side and so as on the asset side. So a scenario like that, I think on a full year basis, maintaining the margin of almost in and around 3% is quite possible, and that is what we aspire. But we told market that because Q1 is a very important quarter, we'll give a full year guidance only after Q1. But hopeful of maintaining the margin that we have achieved in last year, FY24-25.
Talking about the loan growth, now domestic loan growth has been above the industry average. You can call whatever has quarterly numbers we have seen so far. Which are the sectors which have performed for you? Which are the pockets you feel that the loan growth will be visible? And also if you can give guidance for the next year.
See, on the guidance loan side, we are holding that 11 to 13%, but with the liquidity back into the system now, if it is sustainable and durable, I think we can upsize this growth. So the domestic growth for this year has been almost at 14% kind of a number. And within that, the retail is growing at 20% and would continue to grow at 20% for this current financial year. And agri and MSME, if you see that the growth is 14.2% in March 25, and which is almost 300 bps more than that of March 24. So clearly improved our delivery model in terms of both agri and MSME. So if you look at FY25-26, I think the RAM, which is retail, agri and MSME, this is going to grow at around 14-15% on a book as a whole. Corporate, our almost 9%, 8.6%, and I think we'll achieve 10% this year with the liquidity back into the system. So scenario like that, our key growth, in terms of the segment, will continue to be as it is for all this year, as compared to the last year FY25. With the liquidity back, we'll be in a position to upsize that. Within corporate, the renewable sector is a champion sector for us. We are focusing on the road, we are focusing on the services. There are good demands happening in the market, and I think we can achieve a 10% growth. On the retail, my almost 60% of the book on the retail loan is housing or mortgage based. So continue to focus more on the asset base on the retail side also. So I think with all this combination, we have a good potential to grow even higher than the current year growth in this year.
Although your asset quality has improved, if you talk about fresh slippages, which are close to 2,900 in this quarter, if you compare with the last quarter, it is slightly elevated. What is the reason for that, and is there any stress which is building up?
Let me put a few data points on a context. If you look at the slippage for the full year, it's lower than that of last year. And if you look at the recovery for the full year, it is higher than that of last year. And if you look at the slippage and recovery for this year, the recovery is higher than the slippage. So in terms of the numbers within that asset quality, we are in a much better asset quality at the Q4, even if we are talking about the full year. Talking only on the Q4 vis-a-vis Q3, which again the point that you talked about, as against 2,500, the number is 2,900. If you look at the Q4 of last year, the number was 2,900.
Yes.
So there is no change on a YY scale. The 2,500 to 2,900 on the slippage, if you look at my recovery numbers for the Q4 over Q3, the recovery is higher than, incremental recovery is higher than this 350 or 400 crore. So net to net basis, I have gained this quarter rather than any additional slippage. Looking at the slippage component also, a bit of numbers which has increased on the retail and MSME, but the corporate slippage has been very benign, it is all-time low. So on overall book perspective, the number is well under control. This is the slippage ratio for the full year is at 0.7 as against 0.99 earlier. The credit cost is all-time low at 0.47. So I think on an overall picture of asset quality, the bank has a very strong asset quality. One more data point I'll tell, the collection efficiency for March 25 is 98.6, which was 98 last year. So in terms of everything that we look into the book, I think everything is well under control, and the bank had a very strong asset quality as on March 25.
If I ask you some kind of a forecast, because since the time you have taken over, there has been many challenges. There was RBI embargo, but in past 2 years, shareholders have been rewarded with over 1% of ROA. Now, what do you want to guide to shareholders now in the current year?
So that's a fair ask. We have been consistently having more than 1 ROA for 11, 12 quarters now. And we compare a couple of things. If you look at the book value, which is again building off the fundamental scale, the bank's net worth, between March 25 over March 23, it has improved from 148 to 220. So almost 75 rupees is the accretion in book value, I mean in 2 years' time. And that's something significant. That's absolutely significant. And the EPS journey has been very strong. The dividend payout, actually, we have announced 8.35 for every 2 rupee face value. So it's all-time high. The growth trajectory on the dividend also from 5.5 to 7.6 to 8.35. So to the shareholder, we, looking at how do you create intrinsic value and reward them well. So if one line, I just think on the shareholder interest vis-a-vis the bank, I would say that the bank on a fundamental scale is doing extremely well.
If you like this video, then like, share and subscribe to ET Now.